Today, I want to talk about gifted down payments. Because if a parent or another family member is helping you get into your first home, there's a lot more nuance here than just, get a check and a gift letter and move on your merry way. So I'm going to go through the process and the lender guidelines on this. And also, there's actually a specific point where a gift stops being treated like a gift altogether. And most people have no idea when that happens and what that even means. So, whether you're the one receiving family help for your down payment or you're the one doing the gifting, stick around because this one is going to save you a confusing call with your lender, wondering why they're suddenly asking so many questions. Let's begin. Okay, so in mortgage terms, a gift has a very specific definition. It's money from a family member given with zero expectation of repayment, used toward your down payment or closing costs for a house. That last part, no expectation of repayment, is the key disclosure or declaration here. The second, there's any understanding that the money gets paid back, even informally, it's not a gift anymore. It becomes classified as a loan, and loans get treated completely differently. They show up as debt. They affect your qualifying ratios. And if you don't disclose it and a lender finds out later, that's a real problem for your file. Lenders care about this distinction because it changes the math. A gift doesn't touch your debt service ratios. However, a loan does. So the declaration or disclosure of it really matters. It's of critical importance and can absolutely change the outcome of your file. And here's a part almost nobody knows. If that gifted money has been sitting in your account untouched and you haven't moved it around from a million different bank accounts for 90 consecutive days before you apply, it's no longer treated as a gift at all. At this point, in the lender's eyes, it's just your money. So it's what we call seasoned. It satisfies the anti-money laundering paper trail requirement all on its own because there's now a track record showing that the funds have been sitting there with no last-minute transaction tied to your application. So, I know what you're probably thinking. You're asking like, okay, why would anyone bother with a gift letter at all if they could just wait 90 days? And completely reasonable question there. The answer is timing. Most people don't have 3 months of runway between when they receive the gift and when they need to close or when they want to close. If you need the funds now, you go the gift letter route. If you've got the luxury of time, letting the funds season actually turns them into your own resources, as we discussed. And as we're about to get into, that opens up more program options than a fresh gift does. This is the part that trips people up the most. Not every mortgage program treats a gifted down payment the same way. Most standard owner-occupied purchases, whether insured through one of the 3 government-approved default insurers or a conventional deal with 20% or more down payment, will let a gift cover 100% of your down payment. That covers the majority of first-time buyers and most repeat buyers too. Then there's a middle category, rental and investment property purchases and certain specialty programs. Think self-employed or stated income files or new to Canada programs often require you to have some skin in the game, a minimum contribution from your own verified resources with the gift only allowed to cover the rest. And then there's a smaller category where gifted funds aren't accepted at all, like period. And usually this shows up in some alternative or specialty lending type of programs where the entire point of the qualification is proving your own financial capacity, not your family's. My personal read here, the closer you are to a standard, straightforward owner-occupied purchase, the more flexibility you get on gifted funds. The more the program is designed around proving your own financial strength, the less room there is for a gift to do the heavy lifting. Okay, let's now move on to who can actually gift the money. There are rules around who's allowed to gift you the funds. Most of the time, the gifter has to be a direct or related family member. This could be a parent, a grandparent, a sibling. Some programs, however, extend that to aunts, uncles, or in-laws, but it varies with lender and with the qualification program. What you generally won't see accepted is a gift from a friend, a business partner, or an unrelated third party. At that point, it starts to look a lot less like a gift and a lot more like an undisclosed type of loan, or worse, a red flag for money laundering. Lenders, and that's what how lenders would perceive it anyhow. Lenders would rather see that kind of arrangement excluded entirely than take on that risk. And lenders aren't just asking who gave you the money, they're asking whether the relationship itself makes the no repayment expected part believable. Now on to the easier stuff here. For a gift, the verification process is way less stringent than proving your own savings. Usually, all that's required is a signed gift letter, one that names both parties, states the relationship, confirms the amount, and declares the funds are non-repayable, along with a bank statement from you, the recipient, showing the funds landing in your account. Okay, and that's it in most straightforward cases. Compare that to proving your own savings, your own sources, where a lender wants a 90-day account history and an explanation for every irregular deposit that's coming in and out of that bank account. Ironically, the gift route often ends up being the easier path. Now, there's a couple of exceptions worth knowing about here. The first one is gifts from abroad. If the money is coming from outside Canada, expect extra layers of verification. Typically, that means a bank statement showing the funds at their point of origin, confirmation and paper trail of the wire transfer itself, and finally, the deposit showing up in your Canadian bank account. It's not that the lender doubts the gift is real. Anti-money laundering regulations require them to trace the money's full journey, not just where it lands. The second one here is, and this one's non-negotiable, gifted funds originating from sanctioned or restricted countries generally won't be accepted at all, regardless of how clean the paperwork is. Like places like Iran or North Korea, that's a hard line tied to Canada's sanctions and anti-money laundering laws, not something a broker can work around or a bank. So I'll leave you with this. A gifted down payment can absolutely get you into a home, but how it's treated changes based on timing. The specific program you're going into, who's doing the gifting, and where the money is actually coming from. So if you're expecting help from family for your purchase in the form of a gifted down payment, the smartest move is figuring out which of these categories you fall into before your deal suddenly becomes live and the clock starts ticking towards your condition state. All right, that's all I got for today. Call or text me anytime to discuss this episode or others in greater detail, especially if you're in British Columbia or Alberta, as I'm licensed to service these specific provinces. Call or text me at 604-800-9593, or you can get me on WhatsApp, or just go ahead and link up to my website, homefinancingsolutions.ca, where you'll find my complete catalog of past blogs and podcast episodes. And one more thing, check out my award-winning mortgage app. It's embedded somewhere in the notes or profile section from where you're listening to or viewing this. This thing is amazing. It comes equipped with tons of calculators, market interest rates, and every other thing you can imagine. It even enables you to do a snap pre-qualification on yourself. You got to check it out. Give it a try. Thank you again for tuning into Mortgagenomics Canada. Stay well, everyone. Talk again soon.